Hey traders, welcome back to the channel. Today, we're going to take a deep dive into the MACD indicator. It's one of the most popular tools out there, but it's also one that people often misuse. We're going to break down how to really use it, going way beyond just basic buy-sell crosses.
I'm going to be sharing all of my best tips and tricks with all of you.
Ready? Let's dive in. Alright, let's start with the basics. It stands for Moving Average Convergence Divergence, and it's basically a tool that helps us see trends and momentum in the market. It's like a visual way to see how powerful a price movement is. It's made up of three main parts. On the MACD line. This line is derived by taking the 12-day moving average minus the 26-day exponential moving average. This is how we get the MACD line based on this calculation. It's like a faster moving average because it reacts more quickly to price changes. 2. The signal line. The signal line is simply the 9-day EMA of the MACD line. This is a slower moving average, so it lags behind the MACD line. 3. The histogram is where you just take the MACD line minus the signal line. This shows the difference between the two lines, and it's how we measure momentum. 4. The zero line is the center of the MACD indicator. Now, how do we use this thing? One of the most popular ways to use MACD is to keep an eye on crossovers. When the MACD line crosses above the signal line, that's often seen as a buy signal, and when it crosses below, that's a sell signal. But here's the catch. That's where most people stop, and that's where they might run into trouble. Using the MACD by itself can sometimes give you false signals, especially when the market isn't trending strongly. That's where some extra tricks come in handy. Now let's talk about identifying momentum and reversals. The MACD's histogram is especially helpful in these situations. When you're checking out support or resistance levels, it's super helpful to see how the price moves towards them. Ideally, you'd spot some big clear moves with long solid candles. These are the signs that could lead to a potential reversal. The histogram's bars are like a story unfolding before your eyes. When you see the histogram bars getting bigger and bigger, it means there's a strong momentum. When you see the histogram bars getting bigger and bigger, it's like a sign that there's a lot of selling pressure, and it might be a good time to think about going up. It might seem a little counterintuitive, but when you see a big drop, it's a sign that a reversal might be coming. So this could be a great time to go long. On the other hand, if you see small and weak histogram bars, that's a sign that the price is likely to continue in its current direction. Now let's talk about trading with the trend. The MACD is an awesome trend following indicator, but it can give you false signals if you use it on its own in ranging markets. So we need something else. When trading long, we should only buy when the overall market trend is also up. And the opposite is true for short trades. The easiest way to do this is to use the 200-day moving average. If the price is above the 200-day moving average, it's rising. If it's below, it's falling. This moving average is like our secret friend, keeping an eye on the trend for us. Now, how do we use this information? Here's the cool part. If you're planning to buy and hold, just wait for the MACD line to cross upward below the zero line and make sure the price is above the 200-day moving average. The 200-day average is like a filter, helping you make sure you're in an uptrend before you open your trade. Now, when you're shorting, you want to do the opposite. The MACD lines need to cross downwards above the zero line, with the price below the 200-day moving average. This strategy is great in volatile markets. Let's talk about how you can use the MACD on different time frames to spot trend. If you're trading on an hourly chart, you might want to check out a higher time frame like a 4-hour chart to see the trend. For example, if the 4-hour chart shows an upward trend and the MACD histogram bars are green, this indicates that the overall trend is also upward. Now, if you go back to the 1-hour chart, you'll see some red bars on the MACD. These red bars show smaller price retracements on the lower time frame. No need to stress, it's all part of the learning process, and it's important to pay attention to the colors of the histogram bars. If they're becoming lighter, it could mean that the retracement is almost over and the price will return to its main direction. And when you add our 200-day dynamic trend, which we added a few seconds ago, you can see whether the trend will continue, rebound, or change direction. I've got one more tip for you about breakouts. If you're trading breakouts and the MACD histogram bars are big, it might be a good idea to hold off. When the histogram shows a significant movement, it usually means that the price has already moved too far. Instead, it's best to wait for the MACD histogram bars to flatten, almost like a flat line. This is a sign that the market is about to experience a big shift in either direction. I'm excited to share a strategy that has proven to be very profitable. It's a method that allows you to trade using the MACD indexer, and it's built on a strong and reliable foundation. First, let's look at a potential long trade where you buy. We'll focus on the GBP/USD currency pair. We're using the 1 hour chart here. First, we look at the 4-hour chart. We do this to understand the overall trend and filter out low probability trades. On the H4 chart, the MACD line has crossed above the signal line and the histogram bars are green. This tells us that the higher time frame is biased toward higher prices, and it's safe to look for buy opportunities, but only after we receive the correct confirmations on our 1 hour time frame. Now let's switch our attention back to our 1 hour chart, where we intend to open the trade. We see that after an initial uptrend, the price has been pulling back recently. We are approaching a key support level that we previously identified. This is good. Now let's look at the MACD histogram below the price chart. This is where we can see the market's momentum. If we look at the histogram bars, as the price drops, they are getting larger and red, indicating a strong downward momentum on this pullback. Remember, we don't want to jump in on this. We want the histogram bars to start getting shorter. As the price approaches the support level, the histogram bars are becoming smaller and lighter in color. This is a key signal that the selling pressure is dropping, which suggests that the price may soon start to rise. Okay, now we wait for the MACD line to cross above the signal line. This is another important confirmation for us. But remember, for this to happen, the line must cross below the zero line. We can confirm that is the case. Great. Finally, we look at the price in relation to the 200 moving average. We can see the price has come down to the support level where it bounced, and the current price is above the 200 moving average, telling us that the overall trend on the 1 hour is up. Okay, with all of our conditions met, we can confidently open a long trade at the current price. I'll place my stop loss just below the support level and set my target at double the risk. This is a good risk to reward ratio. This is what a high probability setup looks like when combining MACD with the 200 moving average, key support and resistance levels, and using multiple time frames. Yes, friends, I'm so excited to share everything you need to know about the MACD indicator and the strategy I've used for years. Don't forget to like the video, subscribe to the channel, and comment. I can't wait to see you in the next video.